Welcome to Topline, everybody. It's episode 62. It's your host, Sam Jacobs. I'm joined by Asad Zaman, CEO of Sales Talent Agency, AJ Bruno, and a special guest from Stage 2 Capital. AJ, why don't you introduce our wonderful and estimable guest?
Oh, I love this. I have done an introduction for Liz on stage multiple times, so I feel like I know Liz's background. But for Asad and Sam yesterday, I ran Liz's name through ChatGPT. And the most disappointing thing was to find out that ChatGPT didn't know Liz's dog's name, which is Bear, by the way. So yes, Liz is a partner at Stage 2 Capital. Before that, she was a partner at OpenView in Boston. Before that, she was an operator where she built out the BDR team at NetSuite. But most importantly, she has a dog named Bear. She and her husband live in Boston, and they have a lovely home in Vermont, which, Liz, I don't think you're in your Vermont home today.
I'm in Vermont right now.
Oh, you are in your Vermont home.
Which means average internet quality, but more space.
Still better than AJ's internet.
It was better than AJ's internet. Yeah. With the great thing that we did halfway through this podcast, which has worked out really well in my favor, is that we switched to Riverside, which records locally. Yes. So even if you drop off, we're still talking in the background, which I have to go back and listen to the episodes and listen to Sam making fun of me when I'm not on internet. So
it's not just me that makes fun of you. The world makes fun of you.
Yeah.
We're all shocked that this tech CEO has so many tech problems. It's like the running joke, yeah.
And no one has sent him like a Starlink satellite.
I've sent him the link a few times. He refuses.
Do not worry, Liz. JR has done that. That's the other thing. Liz is.
Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asad Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
This episode of the Pavilion Podcast is brought to you by AirCall, the business communications intelligence platform. With AirCall, you can bring your CRM and help desk together with your phone, chat, and messaging system to save time and resource on customer communications, admin, and reporting. To deliver an even better customer service, visit AirCall. That's AIRCALL.io. There we are. Liz, did I miss anything in your introduction? Was that
No, you got it.
You didn't say her last name, so Liz Christo.
Commonly known as Kane, but there you go.
Exactly.
I'm working on that name change still.
Welcome to the show. Asa, do you want to kick us off?
Let's do it. Liz, we're excited to have you. We thought we could talk about 3 topics. One would be your insights as an operating partner. You come from a really strong go-to-market background, so you support these organizations in a pretty hands-on way, and AJ loves your support. So we'd love to hear about the insights you've uncovered from that angle. We want to get your thoughts on the overall VC landscape. And then if we have time, we would love to learn about Stage 2 as a business. I think very few people ask VCs about their business, and we're curious, so we'd love to touch on that. Let's start with the operator insights. So the thing that everybody is talking about these days is the situation with NRR and GRR. The data that's coming out from various different parties, while the data is different, it tells the same story, which is that in 2023, companies really struggled to retain their customers and to find expansion within their existing accounts. That problem seems to have continued into 2024, maybe not with the same level of ferocity as it had last year, but it's still there. And so this leads to a lot of questions. When we talk to founders and operators, they're trying to figure out, how do I solve this problem? Do I have to change how I structure this team? Do I have to change how I pay these people or who I hire into these teams? Whose responsibility is this? And there's just so many questions. People are looking for answers. So we'd love your thoughts. You've probably been wrestling with this as well. What are you seeing when it comes to NRR, GRR, and things that are actually working maybe for companies that have been wrestling with this?
Yeah, for sure. I mean, this is such a big topic, and you're right. It is like an across the board, everyone is thinking about it. I think the first thing is just like diagnosing what the challenge is here. And when we talk about GRR and NRR, there can be such different things going on. We can see a like high logo churn environment. You can have low logo churn, but no actual upsell path. And like when you get to the root of those, there's just very different answers, I think. So I don't know, I start by just thinking about like what is driving that lower NRR, lower GRR scenario. And then maybe like one level further in that, thinking about if there are different cuts or segments of the customer base that are performing differently. And I think that work needs to be done up front to really like lead to any of the other things you've said. And it's surprising to me actually like how often a business just looks at like the aggregate and doesn't break that down to understand better like what's happening behind the scenes. I don't know if that like tracks with what you guys say.
No, the cohort, absolutely. I mean, we've talked about this even in our board conversations of just, if you can do cohort cuts, it definitely can tell different stories, because your motion this year in terms of your new business selling could be radically different than it was last year. Certainly the market environment is. And so looking at the 3-6 month cohorts of like, okay, the customers at the beginning of the year are actually expanding pretty fast. And something that Andrea, the CRO at Help Scout, Help Scout said that was really interesting is your newer customers expand faster than your previous customers. And so being able to diagnose that and understand, well, what does that mean? And what do those customers look like that are different than the others is absolutely work that I think is hard, because founders have to have that data to be able to do it. And if you don't have it, then you're manually having to dive into it to figure out what that looks like.
Totally. I work with one portfolio company that sells into restaurants. I'm just going to use them as an example because it's tends to be like SMB, pretty high endemic churn. And trying to understand the different segments of their business has really helped. So like if it's a one unit, like mom and pop style restaurant, there's a lot more churn than if you're selling to like a, 10, 20, 100 unit chain. And so we had to start looking at that really separately. And then you start to make some decisions about like, do you want to sell to that one unit restaurant? And you might make a decision that like, you're okay with that higher churn because it's brand awareness, it's like penetration in a city or a market. And like, there's plenty of reasons why it's okay to have low GRR in one segment if you can make up for it elsewhere. But like that was a really interesting cut of the data of just like size, even more so than like cohort in that case. And then to your point, AJ, the cohorts in that one are doing the same thing you described, which are like the newer customers, more functionality, kind of bought in on this newer vision of the company, are definitely performing differently too.
Yeah, and it's just also helpful for the founders to be able to tell that narrative going into a board meeting or conversation, even with the management team, to understand that, because that helps set the stage where it's like, we're okay making the trade-off that this set of customers does have a lower GRR or whatever the case may be. Yeah. You're not hand waving it as long as you're admitting up front that you're doing that. But this is what we expect to see in the next 6 to 12 months based on this cohort, and being able to call that shot. Then that sets the expectation. Then in the next board meeting or wherever, you can go back to it and say like, hey, this was our thesis and this is what we got right with it. And this is where signals are still a little murky with it.
Yeah. Well, and then, go ahead.
I was thinking, when you look at some companies, you're able to identify through this cohort analysis that there's actually a place for us to double down and a place for us to avoid, and that might have a beneficial impact on the net number. In some other cases, you notice it's a pretty averaged out problem. Right? Like they're noticing it might not be a disaster, but there's a problem that's pretty across the board. And they might have to then look at things like structure of team, things like who owns this target and how do we do this? I'll give you an example. Gong has now given their AEs 1 year with every account. Mm-hmm. So there's these shifts that are happening in the market. Winning by Design has been pretty aggressive in saying that the right way to structure a CS team is as a profit center, where you give them upsell in addition to renewal, forget the old school method. Where do you land on all of this? Like, are there any strategies or tactics that you guys have implemented in the last year that you've noticed actually move the needle, that are more structural?
Sure. I actually think the first one is around the pricing model. And like one of the most undervalued things you can do is actually experiment with pricing. And I think often it just is sort of like a set it and forget it. And I think particularly for early stage companies where your product is changing so fast and you're adding features, sort of the natural state right now is we just keep making the product better, but we don't think about which of those new features or new valuable things you're building actually could lead to increasing NRR and be an upsell item. And so one of the things when I think like systemically about NRR and how you drive an upsell motion, it's like first looking at your pricing model and do you have the ability to actually drive upsell, and like what are the levers that, whether it's an AE, CS, who's doing it, we can come to that. Like what are the like levers you can pull? And often I feel like it's like one thing and it's like seats or units or like insert thing here. And that is just so hard to upsell in this environment. Like you're basically waiting and saying, I'm banking on my customer to grow, not like I have control of this. And so thinking about, are there ways to price different features? Are there new things you should be doing in product that can drive additional upsell motions in the future? Just one of our portfolio companies just did an offsite on that exact topic with their leadership team, which are like, what are like the short-term things that like customers are asking for that we believe are like tied to like clear value that we could sell? And it's a very short-term view of this, but I thought it was a really interesting way to think about how to impact the next 6 to 9 months.
Is this where discounting can be helpful as well? Like if you discount for a short period of time, you get to hold on to that customer base while you put in the pieces that eventually would allow you to really properly retain them and expand those accounts. Like can discounting be used more effectively and strategically to help manage this churn problem than maybe the ecosystem has been using? What are your thoughts on that?
Yeah, potentially. I think that is so company dependent. I'm working with plenty of companies where there is no real concept of discounting. It's like you click and there is pricing on the website and like that is what you get. But yeah, and in like a more mid-market or enterprise motion where you're talking to sales about pricing, I think that's a really interesting idea.
I think there's three parts to churn, I think. One of them is pricing and packaging, one of them is the ICP, and one of them is the process of how you manage the client. And I think that's what we've been focusing on is like, let's make sure we're onboarding the right way, because you can do cohort analysis based on like the type of customer, but you can also do cohort analysis based on what products or features have they used and how does that relate to long-term retention. So then you can say like, what's the quickest time to value and how do we make it so that we get the right products and services from the bundle in front of them as quickly as possible that will ultimately drive long-term retention. I think some of the feedback that I've gotten recently, at least from my board, is, hey, before we change pricing and packaging, let's make sure that the supply chain from onboarding through their first couple of renewals, like that is designed the right way and that we've gotten as much lift as possible before we move into pricing and packaging. I don't know if that resonates at all, Liz.
Yeah, I mean, I like the way you laid out those 3 pieces. I'm fully with you, like understanding what an activated and engaged customer looks like and continuously monitoring that makes an incredible amount of sense, right? You're not going to go and try to upsell and add some sort of new pricing lever to a customer that's using 20% of your product or isn't engaged. But it probably just starts with defining it. And so you laid that out in sort of the concept of like, what is somebody's path from sale through the first couple of renewals? And that buyer journey, I think, often stops for many companies at the point of sale, not thinking about, okay, from the point of sale, you've got a whole different thing you have to do, which is get them onboarded, get them activated, figure out how to keep them engaged through renewal and future renewals. And so building out what that ideal path looks like from the point of sale forward is a whole nother journey that needs to be mapped.
AJ,
have you
sorry, Sam, go on.
I just one follow-up question. As we've moved into this world of like lower gross retention, lower NRR, my question is fundamentally about like maybe the market and the connection of that to valuation and ultimately to like check writing and investing. Has the pace of investing at stage 2 slowed down as you've seen companies struggle more with retention over the course of the last couple of months? Or are you still as optimistic and maybe you're pricing in, maybe it's reflected in price as opposed to whether or not you invest at all? Or maybe it's perhaps even less priced in because you're saying this is the environment now, but we think it'll improve?
Our pacing has been very consistent. So I'll say start with that. But I do think there are some things we're noticing, and you're right. Like depending on the company, one company in particular that I'm thinking about that has lower NRR. They do tend to sell to smaller businesses, and they're like making the shift up market. Growth, like top line growth, has been incredibly quick. The retention profile was like improving, but probably not where we would want to see it. And when you think about like long term, how do you build a really big business? Like NRR has to be higher, right? You're not going to ever get there if it's 90% and certain number there. It's just so much to make up for. We did price it into valuation. And so that was a investment we did make. We saw a path to improving it and thought more about like, how do you price in that risk? In other cases, it's a non-starter. I think it really depends on the company we're looking at and how both the trend we're seeing and then also how we think that can change over time.
How do you, what are the levels there? Like, at what point is it too scary? In a situation like the one you described, is it like 70%, 80%, like 90%? Is there a number at which it's like, we can't even look at this, versus one where it's like, okay, if there are a number of other really positive signals, this is interesting?
Yeah, this one was like in the 90s. I would say generally, like when we're looking at NRR, not
NRR was in the 90s.
Sorry, NRR,
probably like 70s on gross.
High 70s, yeah. And I would say, I don't know that there's like a hard cutoff. And like, you will hear that from investors that they won't do a deal that's under 100% NRR or they 105, 110, like pick your number. I do think that tends to be bigger indicator of what the valuation is going to look like and like where that falls in like the decile of companies and opportunities that are out there. I don't know that I have like a hard line in my head of this is like a deal we couldn't do, but we did look and do one recently that has less than 100% NRR, and if we see a path to improve that.
That seems very reasonable. AJ, you made a really interesting post on LinkedIn about a customer that churned, right? And you've got this interesting thing going on in your ecosystem where you had a competitor bought by a really large company. Large companies bundle, they can offer things for a lot cheaper, maybe free. So what do you do when you are churning to free? Like, it's not, they might love you and your product, but it's for free. Sorry, AJ, I'm out. What do you do about that as a founder? How do you sleep at night after that happens?
I think
all right, I'm just going to wrap it up. I'm shutting it down.
That's it. It's over. It's got one customer.
This is it. This is Asad pushing me out of the podcast.
What a question.
The post had a lot of really interesting comments and great engagement, and I think the it's easy for me as a founder to like say, oh, it was because of this thing. It was because this other company offered it for free, possibly, and that is a real possibility. But there's obviously a lot more to go into, and I think I can't remember who made the post, but it was just going into the conversation that we're going to have tomorrow that I'll be a part of with the customer and just saying like, first off, I'm sorry, just outright owning that and apologizing forever, whatever it was. Doesn't matter what it was.
You're going to apologize?
Yeah.
For what? You don't even know yet. What if you did nothing wrong? It was just free.
My CEO coach gave me the best advice that he talked about this. There was a $50,000 deal that he had done with IBM back in the 90s at his own company. And he had a coach. They weren't going to pay. They were like super frustrated, super upset. They were not going to pay. And his CEO coach, this woman, was like, Glenn, you need to just apologize right up front. And he was. Does that get bleeped on this show, by the way? I don't think we've ever used that. I'm sorry. By the way, at the CRO
it
Summit,
is.
Everyone appreciates how much we don't swear on this podcast. So I'm going to try. I'm sorry. I apologize out there if it doesn't get bleeped.
We'll bleep it. Okay, go on.
I will bleep it. So he was really ticked off with that message. What do you mean I can't, I'm going to apologize? They owe me $50,000. She said, don't, Glenn, just apologize. So he went back and forth, and finally he walked into the room and he just said, hey, I'm so sorry. I apologize. I take full accountability and ownership of the problem. And it just like took everyone like back a second, and just everyone pulled back on that giant mask that they were wearing, and he walked out of the room with $50,000. So I don't necessarily expect to walk out with a customer contract tomorrow apologizing, but I do want to get real answers.
Yeah.
And I think that ultimately, if I apologize up front, which we did something wrong in this contract, I'll hear about what those things are.
Yeah, it changes like the tone and tenor from the first step.
I think it's a nice disarming strategy. I'm in Canada. I'm a Canadian. We say sorry all the time. I still think
your default disposition up there.
I find it really difficult in these type of situations, and this is probably a flaw in my personality. But unless and until I'm wrong, I can't say sorry. So that's why I was taken aback. But as a disarming strategy, it makes a lot of sense. So you're gonna go in, you're gonna learn what happened. If let's just now play. Separate from that particular instance and say you came out and you learned that it was just this idea that you have a competitor that is being offered for free. How do you protect against that? What are your thoughts there?
I think there's a great opportunity to talk to the management team and really come up with from a strategy standpoint. This is actually something that I might take to the board, take to Liz, take to Pablo, and ask if they're seeing it in their other companies. It's probably really specific to us, is what I'll hear. Which is fine, but there's plenty of situations where, let's just say a Salesforce acquires a Pardot, and then you're a Marketo or you're a HubSpot. You're like, oh, what do we do? How do we? This play has been done before, and so it's a really good opportunity for me to go learn and look at history and to understand where they came out. I mean, both of those companies came out on top, I would say, in different ways. Going through that, I had a smirk earlier, Asid, when you were asking Liz about thinking about valuations and how stage 2. Liz is right, and I see this as an LP as well, as they've been very consistent with their investment strategy and thesis, which I really appreciate. But it's also means that they're in competitive deals because they back great founders. So a lot of this is just seeing this and understanding it. And I think something that's unique about stage 2 is a pod structure that they have within their partners, and it's just a really interesting thing. And Liz can talk to it as well, but Liz, I think with jumping back to just your investing, that pod structure seems to be a unique differentiator and an edge that stage 2 has that helps. I know you and Dan work really closely together and have for years. Is that something that you see as a differentiator in stage 2 as well?
Totally. So just like for everybody else, the pod idea is basically 2 partners work hand in hand on every deal. Somebody who comes from a more traditional finance VC background, someone who comes from the go-to-market and operating background. And when you look at VC right now, you basically as a founder are making a choice in the profile of person who you work with or who joins your board. And you can either get somebody who comes from a really strong operating background, but probably doesn't have a lot of the VC and governance chops that may be part of what you want in a board member, or you get the flip side. And so the idea here is basically we both lean in on every deal. We keep each other up to speed, and you get to call on who you want. And it's really kind of funny, CEOs and founders use us very differently, and even across our portfolio companies engage with us differently. Sometimes they always come to both of us, and it's whoever gets there first. Sometimes it's very clear swim lanes of the things they work on. But example being if we're hiring a first VP of sales, I'll get involved in that process and interview folks. Dan's not going to jump on. If we're building the model for next year or going out for a fundraise, Dan's probably more actively involved. But it's actually it's been a really big differentiator for us, both in just the time we can spend with a company. It's 2 instead of 1, and allows us each to lean into our strengths and not feel like we're stretching.
I've heard this from a number of stage 2 companies. They absolutely love this. Does it help you win deals? Do you get a discount on valuation, or is it a differentiator when trying to win against other companies that are also trying to position the extra support that they can provide? Or is it more so that it helps you actualize the potential upside of the investments you are making?
I mean, both is probably the real answer. I think it definitely is a differentiator, and there are founders who opt in and get excited about that model. Raised money, I think the reality is this comes down to the partner and the relationship, and there is some leeway in valuation and deal structure, but are we winning a deal at half the price of someone else? No, I don't think that's really happening. But I do think people tend to gravitate towards people they want to work with, and then within a bounds of a reasonable deal and what feels like a fit, it has definitely helped us win. I think the other side of that is actually just discipline around round structure. And I'm realizing this in a recent deal we did where, if you went with a, multi-stage firm, the round was going to look really different. They're not going to write a $4, $5, $6 million check. It's like a drop in the bucket in a large fund. And so they're going to push that deal to be a $15 or $20 million round. And, it depends on the founder, but there's different structures that are more or less appealing. And if somebody is more dilution sensitive, I think we have more flexibility in creating a deal that can work for everybody. And then post-investment, look, like our whole model, both in how we raise money from LPs and have operators around the table, is really oriented around trying to provide more of that kind of feedback, advice, like people to lean on from an operating angle. And that, certainly need to see it play out, but hopefully is like, a kind of key differentiator in the success of the companies.
If you had to assign percentages for what percent of your winners, to the extent that you've had some, when you have them, is entry point on price, is just your capital providing the growth capital for a company to grow, or it's your advice, the ongoing expertise of the LP base. I guess my point is, like, how much does the ongoing expertise help? Does it help 10%, 50%? When you're attributing the role that Stage 2 played in a company's success?
Oh man, that's a really interesting debate. And I don't know that I have like this is the answer yet. Because to your point, we've been investing since we raised the first fund in 2017. So it's early days in the grand scale of venture. I think, my read on that is like the winners are going to be winners with or without you. And I think a lot of where the advice matters is in like that middle tier of companies and helping people avoid mistakes and or like kind of pull through like challenging moments. And I think that's where we've seen like companies that, could potentially in another fund go to zero. Like we haven't had those bankruptcies. We've been able to land the plane, have an exit, get to profitability, like insert secondary path here. I think that's where the operating experience is probably most valuable, more so than like, hey, you've got this like rocket ship, like, us helping to interview the VP of sales there, probably like not the real needle mover.
Yeah. When I'm thinking about our investor, primarily it was the capital. And I'm not saying this because they're not helpful people. They're very nice people. It was like, and then, but the other thing that's interesting is like, to your point about companies in difficult times, is that it's really like, there's these high leverage moments when just the right advice is so most of the time, honestly, they don't have a very strong opinion. I send them a weekly email. They're like, good job, or thanks. And there's not a lot of substantive feedback, or honestly, sometimes the feedback is like, I've written about this the last 3 weeks, so I don't see why you're asking about it. But I will say that, like, I don't know if this is helpful or not to the point of letting us not go to zero, but like when I was worried about our balance sheet last year, I think they added value by saying there's no more money. You're going to have to find a way to break even. We think you should make deeper cuts. And that conversation doesn't take 10 hours. It doesn't take months. It's basically like a few key moments where they're like, hey, dude, this is what we think. And by the way, if you don't have to do what we say, but we're not writing any more checks into this business. And in that way, they were hugely beneficial from
clarity
an operating
and transparency.
Perspective. And it's like, well, most of the time they're quiet, and then a few times they're basically like, be more profitable, which isn't the most sophisticated advice in the world, but it helped me in that moment, I suppose. Yeah.
I mean, look, I think that's advice a lot of companies have or are getting over the last 18 months, probably at this point. And it is, really easy to sit on the sidelines and say that. It's incredibly hard to sit in your seat and do it. But I also think it can be really helpful to get the feedback from the market, to your point, on what future funding is actually there or not. And I do feel like that's a place that we've spent a lot of time with our portfolio thinking through what are the various paths. So you have X dollars in the bank. We can accelerate burn and aim for this growth path. We can keep going steady state. We can cut burn in half. We can build a profitable plan. Like, these are all options. Like, how do you maintain that optionality knowing what's coming?
Yeah.
Liz, last year was really interesting for board and founder/CEO relationships, right? Like, we were in this 10 plus year ZERP period where life was just easy and everybody liked each other.
It's coming back, Austin. Don't hate on it so much. It's coming back.
6 months.
I feel like the market priced it and it barely moved today.
Yeah, like it's going to take a minute for all that to play out. But yeah, so we were in good times and things were relatively easy and the relationships were generally good. Last year, a lot of our founder CEO friends were having a really tough time with their boards. But some of the mistakes were on the founder CEO side, and some of it was just really bad advice and tension from the investors. It makes us wonder what the right way to structure or balance a board might be, right? You've got the investors that have put money, but there's also independence that can be really helpful. Sam's had a lot of success having independent board members. What are your thoughts on creating balance in a board?
Yeah. Okay, I feel like there's a couple pieces here. I think the independent is really important, but I actually just want to touch on one other thing first. I think, like Sam, you alluded to like transparency with your board of, hey, I communicate every week, and even if somebody isn't responding or engaging, I think that probably makes it a lot easier when there are harder conversations or like down periods because you've been clear on what's going on in the business. I think it's like the onus is on everyone in the boardroom. Like, how do you make sure that you're being really clear, that everybody's on the same page, that you're aware of what's going on in the business? There aren't huge surprises. Like, there's something worse than getting into a boardroom and feeling like you got like, I don't know, hey, here are 2 huge customers that churned midway through the quarter and we never told you about it. Just giving an example, right? And like, that's really hard. And then sets a rough tenor for the rest of the meeting rather than like starting with like, hey, we're all obviously in this together and trying to figure out what the right thing is to do. So I think just like clear communication, consistency, all that helps.
I just like to tell my board over LinkedIn, apparently, what customers are turning and not turning.
They weren't that big a customer.
Did you read my LinkedIn post?
I was very clear.
To be fair, I actually did, and Liz can attest to this, in the last board update, I did like say, hey, just heads up for Q3, here are the two customers that we're worried about, and here's one that's already given notice. So
AJ, you're a very clear communicator, not worried about that.
Yeah, I don't think AJ is the problem in your portfolio.
Nobody there. Numbers months with nothing.
Yeah.
And so I think that's like one piece. And then on the independent front, look, deciding what you want your boardroom to look like, whether you want that to be a board of 3, 5, 7, whether you want observers in the room or not, like all of those things are variables that a CEO gets to decide and work through. If you have an independent seat, I am like a huge fan of filling it. And I've seen, I think over the last, I don't know, maybe 6 to 12 months, like it feels like a really hard and daunting thing to kick off an independent search. And it feels like another allocation of time where you've got to go like run a search, spend time with a lot of people, like find the right one. It feels like, all right, this is another person that's going to be around for a couple of years. I don't want to just jump into something. And I guess if I could like really zoom out and talk about ones where it's worked, fill the seat, like, yeah, take the time to take it seriously and find somebody, but you also don't need to do a crazy long term. Like, do a 1-year term and renew it. It doesn't need to be this forever relationship of like taking capital from someone. And generally, I think having another voice in the room is like really helpful.
I think that's the biggest, my hypothesis, my learning has been, what the hell do I use these people for? Like, what is there's this existential question sometimes of like, what is the point of the board meeting? Sometimes you're not even sure. It's like, we're reading out results, fine. And they're asking tough questions. But maybe that's a cynical view, because recently what we've been doing is we do all the department readouts. We just say, we've assumed you've read the slides. We're not even going to go over any performance information.
Yes.
We're just going to dive directly into discussion about like, these are the key topics. And I think it's somewhat interesting, but honestly, to your point, Liz, like before we had an independent, it's when you're just talking to people that have never worked at an operating company and have only been investors, it's just not, it's not as helpful. What they can tell you about is valuation. But even when other companies do things in similar spaces, they're still on the outside of those companies looking in, and it's still not clear that they understand exactly why those companies work versus not work. So now, but to your point, now it's like I try to put the board members to work. I'm like, okay, like let me pull that person in for some retention analysis because they were CRO of ClassPass and have worked in membership organizations before. But I think that learning curve was difficult for me to figure out, what exactly am I supposed to do with them?
it also takes work from you to figure out how to do that.
Right.
I'm with you on that. It's actually funny. I've had some very different like board structures in the last like 12 months. Like things have evolved a lot. I have one company where we do meet quarterly, but it's like an hour meeting on WebEx, and like it's very
Wait, WebEx?
Results quick.
Wait, literally WebEx?
What a
Oh my God, I don't know why I said that. No, we meet on
WebEx.
We can record it and have local internet. We do like a 60-minute meeting, and it's like quick, it's results. It actually is just like a rather perfunctory update. And then I have other ones who book a 5-hour, like in person once a quarter, like really unpack a few topics. And I guess like my view of that is ultimately these meetings are for the CEO, and like I want them to get the most out of them and have options there. But I don't view one of those as like better or worse than the other. It's like, where can we add value and give you what you need? And the company who does the short board meeting, like uses us in different ways. And that's great. He's like, I don't need 7 of you in the room, like asking the same questions. To your point, Sam, like I get a weekly one-on-one or a monthly one-on-one when I need something, and like, I'm getting what I need.
That's such an interesting point. AJ, as a founder, have you felt that you've had that power, and Sam, you as well, to define how these board meetings, even just the length of it, like the 1-hour one sounds brilliant, but most of my founder friends are starting these like 5-hour meetings. Have you ever in your past company, this company felt like I can adjust, I can figure that out, my choice?
Power is doing a lot of heavy lifting in that sentence. From a venture back.
We have evolved, AJ.
They have, and Liz can also say that my board meetings have evolved so much, and I do feel like they're getting better every single time. And a lot of that credit goes to Liz. I've asked her previously, like, what works in other board meetings, and sometimes it is sending like a Google Drive or a Word doc, I guess. Apparently, if they're using WebEx, a Google Drive, and having the comments. But I found that I've also
I
found
invest
that
in tech companies.
You could have said like go-to meeting. Something that was like
that would have been worse.
The truth of the matter is that I've found where my communication has changed. So one of my board members, Rachel Geller at Insight, when I originally sent over board decks, she would have like a list of things, and she found that I was responding pretty quickly. But now I've that was that was the AJ 3 years ago, and I've just taken a step back and just taken a pause of like, okay, this isn't the most important thing to respond
Rachel.
to. Especially, no, Rachel.
No, it's a good
I've
thing.
told Rachel this. I was like, Rachel, I've learned you can respond, and I just won't respond right back until we talk about it in our one-on-one, which is great. Like that's just been upfront about that feedback of like, I can see that that's probably not helpful for me to be like instant responding to everything, because there are founders that do that. And I used to do that with everything I did. And then it just became like, well, how important is this to you? Like Liz sent me something today and said, hey, can you take a look at this? And I said, okay, just from a timeline, like how important, or not how important, like from a priority, what's the timeline on this? And so just to getting a gauge on that.
You're
for
really
board
clear.
meetings.
I said middle of next week, and he did it already.
Yeah, that's all right.
5 minutes later, he responds.
The reason that is I wanted to get it off my checklist.
Yeah.
AJ, you have a paper checklist?
No. This is a paper of my CRO notes that I have. That's my feedback that we're going to get to.
You have a paper one though. Your journal, like you.
I do have a journal. Yeah, of course I have a journal. I've shown you this. This is like, I have a paper list. Although on my video, those are like going to actually be really, people can read that in high definition. So maybe I shouldn't have shown that. But yeah,
I saw it says, I hate Sam. You intentionally brought it up to that page.
There's this task that just keeps getting longer and longer with Topline. It's like my full-time job these days. Board meetings evolve, and that's okay. I've talked to Liz where she'll join boards, and like coming into a board where there's 2 different voices that she's never worked with, and like, oh, how are you handling that? Are you playing referee? Those are things that you're probably thinking about joining new boards, and you do. I have one quick question though for you: in-person versus remote board meetings, Liz?
Mm-hmm.
Mix. I mean, I think it's really hard to get them all in person, but I think I get so much more out of them when we're actually in person. It's pretty hard to swing all of them that way, both time and cost.
Do you do dinners with the management team, one-on-ones with the management team, make it like a full day?
Total Totally depends on the company. I would say most of them, there's usually like I do some sort of meal with like minimum board members. And I personally like to spend time with the team because it's who I tend to work with a lot.
There was an investment firm on Wall Street, and they were looking for signals on if the earnings reports of these companies that we're tracking are going to be good or not. So one thing they figured out is if the CEO was going to announce good earnings, he had usually booked a vacation and his private jet had been booked for that flight. And when the earnings were going to be bad, he wouldn't book it. And so they would time their bets accordingly. And they made a lot of money doing this. Like this was a legitimate, right? While, so I guess like on the in-person ones, if they book a dinner, then you know we're going to hear good things. If they don't book a dinner, you're like, this is going to be rough meeting.
Yeah, but what if it's a like Taco Deli?
No, but actually one of the things I have noticed is particularly as a new investment and like as a new board is coming together, there's often a lot of nerves. And especially if you're establishing a board for the first time, a CEO feels like a little bit like what is this meeting going to be? And actually having a dinner the night before to like alleviate some of that pressure and like remember everyone's like a human and here to help is like has been very helpful to making the boardroom actually more effective the next day.
I agree. Cool. Well, Liz, I know I put 45 minutes on your calendar and we are at 45 to a T. So I'm sure you have another
get out of here.
upcoming.
Thank you all.
So great having you.
Thanks for joining, Liz. Always great to see you. Thanks a lot. Bye. And now a word from our sponsors.
Okay, everyone, it's time to elevate our go-to-market strategies and accelerate our careers. How do we do this? Well, you can do it by joining us at Pavilion Palooza, which is the premier virtual learning festival for go-to-market leaders happening from June 25th to June 27th. Pavilion Palooza is more than just an event. It's a convergence of ideas, strategies, and insights. Over 3 days, you'll experience over 48 different talks from 48 different speakers, featuring bite-sized, impactful sessions on sales, marketing, customer success, revenue operations, and a lot more. Don't miss out on this chance to gain the insights and tools you need to propel your career to new heights. Register at joinpavilion.com/pavilionpalooza or click the link in the show notes. See you there. That was it's always interesting to talk to investors about board dynamics. That was super interesting. Liz is great.
I like it when our conversations meander a little bit as opposed to following the script of like whatever's interesting.
Yeah, because you're able to like, oh, this is an interesting angle. Let's jump in. AJ, have you noticed that Liz has is Liz's superpower that she was actually a go-to-market leader and a really good one, and so now as an investor plus she has just this level of experience and expertise where she can provide good guidance versus investors that have just been investors their whole career. Like, do you notice a difference, or is that just we read about it but it's not as real?
No, it's very real. I mean, I wanted to make her the independent of QuotaPath. She had the paperwork to be the independent board member of QuotaPath. After she left OpenView, that's how highly I thought of her as an operator versus just an investor. But then she joined Stage 2 and I had a conflict, so I couldn't do it then. But I think of Liz as an operator first, which makes one-on-one conversations. It like puts me at ease having conversations with someone like that, because I know they're one, going to have the best interest for you at heart, and two, they also know what you're going through. They have like a level of empathy that's just really challenging. It can be really challenging in a boardroom. And so I mentioned that. I mean, I've seen Liz do this really well, where she can bring data that she's seeing from both her other companies, but also understanding and working with the go-to-market functions. Like she works with, has worked with Milligan and other go-to-market leaders at QuotaPath, like she does with her other companies. And so she sees this in almost a week-to-week cadence versus the every 3 months we get together as a board meeting.
I'm curious from your perspective as an LP, well, also as a portfolio company. How important was the LP base for you to take money from Stage 2? That's one question. And then the second question is, it's just really hard to start a new fund and try to lead, because you're competing against Excel, and you're competing against Sequoia, and you're competing against Benchmark and First Round, and Redpoint and Index, and all of these amazing firms. So those are two, they're related. Like, did you choose stage 2 because of the LP base, potentially, maybe the expertise you would get, maybe your ability to sell into the LP base? And do you see that working for, on a go forward basis when they're talking about the investments that they're making, that they're winning competitive deals? Because one of the piece of feedback I got, not just about stage 2, but really it's just really hard to build a new fund and try to lead. And that, a much more common strategy is to leverage this operating partner network as a tag along investment vehicle for someone else to lead. Yeah. So one of the tier A firms, they lead, and then you get an allocation because you've got, your CFOs or your GTM experts or whatever. What do you think, AJ?
Yeah, I don't know if this was a brilliant strategy on my part, but I was an LP first. And so I got to see the fund and see these go-to-market leaders. And really, that's what actually engaged me into the fund even more. And so Jay, the managing partner, and I caught up every so often. And I got to see how great it was inside the fund and how experienced everyone was. And that was a selling point for sure. So I ultimately did give stage 2 a discount on our before the Series A. That, to Liz's point around winning those competitive deals, and they're very competitive deals. I was the founder that said, no, you know what? From a valuation, it's not going to be the highest valuation that I could probably receive right now. But I am going to take this because I feel so strong in the network of go-to-market leaders. And there's some great go-to-market leaders that are advisors with QuotaPath. I'll call out Hayden Stafford, who's an official advisor, president of Seismic. And he has an amazing career working for Tom Siebel and being at Salesforce and working for Benioff and all of these great people. I think he was at IBM for 15 years. So he has this great scale experience, but also sees so much on the early stage stuff with stage 2 as an LP, and Seismic, which I think is one of his earliest stage companies ever that he's done. It's a couple $100 million revenue generating machine. But it's just really great to have people like that around the table and then call on them when you need it, whether it's just an introduction and it's easy to get an intro, or if it's meeting in person and talking about a really challenging thing that the company's going through, or even in an M&A transaction opportunity. You think about that. These LPs work at these bigger organizations, at Oracles, where they can get connected pretty easily. So yeah, huge added value for me personally when I saw the network.
Sam, I think that value proposition of we'll have a bunch of operators as the LPs is a strong value proposition. I do think their fund strategy, just as you phrase that question, their fund strategy in this market would put them at a disadvantage, probably, right? Just as an analyst, if I'm looking at it, because previously there was just the bar for what good looked like was lower, and getting to that bar was easier because interest rates were lower, and hence creating momentum in a business was easier. Now creating momentum is harder and the bar is higher. So there's fewer companies, and you are now competing with all those names that you listed out. And stage 2 is an amazing firm with amazing people, but they would not be considered as an equal to Sequoia or Excel or somebody, right? So in those instances, and from what I hear, stage 2 is very disciplined, which might...
Yeah, no, that was exactly what I was going to say, Asid, because, sorry to interrupt you, but Roberge was on stage at the CRO Summit, and it was probably one of the better conversations of a fireside chat that I've had at a conference, because it was so candid and so honest.
I love that he asked if this was being recorded at one point, and then he kind of pulled back on.
Yeah, he pulled back a little bit, but he was still. But the point, I just think the point that you're making is very accurate, which is they go to his point is we go to our LPs, endowments, besides the GTM operators, like the big institutions, and they say this is our thesis, and they can't deviate from that thesis because their LPs have diversification already in other funds. Yeah. They don't need stage 2 to chase random deals. They need them to do exactly what they said, which is write $5 million checks into 1 million ARR businesses that look like this, smell like this, talk like this. And those are competitive deals, exactly to your point.
Yeah. And
Yeah.
so
Sam made a really good point around stratifying the data and looking at it, and actually brought me back to the earlier part of the conversation and cohort, like how Liz helps her company's cohort around NRR, GRR. Well, funds naturally have this, like fund 1, fund 2, fund 3. They literally have the data stratified in these cohorts, which is actually really interesting. So they're already looking at it like that and basically applying those mechanics to their companies and how their companies.
The challenge is that the fund cycle is 10 plus years. And so by the time you get legit data, like Roberge will be retired by the time like these funds play out properly, right? Like,
yeah, but Sam and I were saying our company life cycle is now like in the 15, 20, 25 year.
I don't think we had that conversation on the show though, did we? Or did we?
What are you guys saying?
We talked a little bit about that our company life cycles have extended.
Yeah, exactly.
For sure.
No, just the point that like, you know, we're running the businesses for much longer than 3 years. I mean, I think your point, that's what I was asking her. That's what I was asking Liz about it. Venture is just it's not for me. I don't think it's for me.
Such a tough game.
It's just so long.
Yeah.
You just don't know. And you just don't know if this stuff is going to work. You don't know. And so I can see why most of it defaults to asset accumulation. You're just like, write checks so we can raise the next fund. And if you get enough credibility to be able to be like a consistent allocation in a few big endowments or pension funds or whatever, then like the game is how quickly can you get to a total of $1 billion under management with like 10 people working it.
Yeah.
And then you can make all the money that way without having to generate. You just be like, I don't know. We had one exit.
Yeah. Like if you look at asset aggregators like A16Z is an asset aggregator, like their strategy is that 2% is the 2% management fee. And then let's kind of see if we have decent returns, they'll be okay.
No, that's just when the all-in guys were talking about like, why did they invest in that Adam Newman company? It's like to get $300 million out of the fund so they could be quicker to raising the next one.
Makes you realize how much of a gangster or gangsters the team at Union Square are. Their returns are phenomenal over such a long period of time. And they obviously have much smaller funds, but they're just so good. Is it
evergreen funds though? Is it actual funds? Like they have...
No, they're funds. They raise funds and then they have all these SPVs and, you know, follow-on vehicles, etc. But to your point, Asid, Fred's always like, I can't do anything with a fund bigger than $300 million. Like all I know how to do is run a $300 million fund and write whatever, $5 to $20 million checks from it.
So since we're talking about boards and investors and all of this, there was a wacky LinkedIn post from the CEO of Clary. And so,
let me just take a pause for a second. If you're tuning in, this is what you're tuning in for right now.
This is the tea. We're about to spill the tea.
Okay, so Andy, I can't say his last name, but the CEO founder of Clary, Andy Byrne, he made a wacky post. He basically made a post about how AI is going to change how boards and the companies that they're supporting interact with each other. And the core premise of the post was that now board members will not have to sit back and wait for 90 days to get information about what's happening in the company. They'll be able to prod executive teams on an ongoing basis to get the information when they want it. And we're going to be moving into an active board member phase where the relationship is going to evolve to this almost co-worker type of relationship. Sam, when you read that, I sent it to you guys. When you read it, what did it make you feel? Did you think there's some sense to this, or did you think like, well, yeah, how did it make you feel?
Made me feel like Andy and his team of writers needed something to write about, and they needed to develop. And they're like, "Hey, you need a hot take because that's what gets engagement on LinkedIn." And so they constructed this thing. I didn't understand it. It seems a little silly to me. I have to say. First of all, my board I give them access to all of our dashboards, all of our data. They're updated daily, if not weekly, and they can see it anytime they want. And I write a weekly investor update that's sent every Sunday. And it's not powered by AI. It has nothing to do with AI. I could not draw the connection between AI and this idea. And second of all, I don't understand why it's so that's that. boards have all the information that they would want anyway. And I also just don't understand the thesis that the whole structure is that you hire a CEO because you believe in them to have a vision to organize that group of people towards a common purpose and mission that will achieve economic value and also deliver shareholder value and customer value. And the board is a governance arm that sits on top of all of that just to make sure that things happen and that there's a check on the powers of the CEO, as I understand it, and also to represent the shareholders more directly to the CEO. But I don't see what that has to do at all with AI, and I'm not sure why AI would mean that we throw that structure out the window. You still need a boss. I don't see why the structure is called into question. It doesn't make any sense to me. So no, I don't think AI is going to mean that. Peter Fallon at Elephant has a lot of stuff going on and really doesn't want to be more involved than he is. Yeah. He's having like his fourth child. Like, he's fine. He's fine. He writes, "Thanks for the update" every Sunday. He has expressed no interest at all in being any more involved than he currently is. And that's fine with both of us. So I guess my general impression from that post was I didn't understand it. And it just felt like, I think it was like about AI because AI is topical. AJ, what do you think?
Well, do you know what was powered by AI, Sam?
That post.
Yeah. I stopped reading it halfway through. I was like, my goodness.
It felt a little AI to me.
It felt a little AI. Well, his content guy left, right? Devin Reed was the content guy. And there's been
he made a post on how he it created 1 million impressions and it was like, peace.
And then the content dropped.
Yeah. Everything you just said, Sam, I fully agree with. And similar for my board is they wrote an email saying great progress. Had a one-on-one with them. And that was
the idea that it's like you've got JR. There's a few people that are just bored. Sorry, JR, but they're like, they don't have enough to do and they're sticking their nose in. But most of them are like, whatever. Let me know. Are we going out of business? No? Great. Keep going.
Yeah. JR and I, just for the record, have a fantastic great board founder relationship.
I think people don't understand.
They do not understand
the purpose of a board, like just organizational design and structure. Like the purpose of the board is not to be operators. Like it's a fiduciary responsibility. It's picking a CEO. Those are the core responsibilities. You absolutely do not want board members messaging your VP of sales on an ongoing basis. There's also a stature that a board member has. So imagine a Series A VP of sales, first time VP of sales, maybe second time, getting a message from a board member from, I don't know, Redpoint. They want to drop everything to handle that message. And so that creates an inefficiency within the organization. So while this post made it seem like it's going to become more efficient, it's going to make businesses inefficient. And I would think there's going to be a huge revolt over that. So
I can't wait till Clary goes public and we get AI earnings calls. It's going to be great.
I want a public dashboard of everything that's happening on Clary on a day-to-day basis. All right.
Shout outs, wins of the week.
Wins of the week. I'll go first. I know I rarely go first. I am going to give a shout out. I reposted it on LinkedIn. So to my friend Jordan Gutman. So Jordan used to work at Yelp. He was a salesperson at Yelp. And when I was running Axial, I was the head of sales at Axial. I hired Jordan to be an account executive, and he was as we say in Yiddish, he was a young pisher. So he's a little pipsqueak, a little pain in the rear end, sassy, smart aleck. But that was back in 2010. So that was 14 years ago, and since then it's evolved from boss employee to mentor mentee to now just friends. And we spent 30 minutes on the phone on Monday night, just chatting and catching up. And that was the inspiration for this post that he wrote, which I thought was really quite interesting. And so what was the post? The post was, he says, when things feel too easy, when you feel like everything's working, you have this amazing product market fit, your instinct is to extract leverage, to extract concessions from the market because you have leverage and you believe that you have leverage. And what you're doing is you're inviting competition. And I found that to be really interesting because most people I've heard encourage you to raise prices. But every time you raise prices, you are creating an opportunity for underpriced competitors to come in. You're also just futzing with a good thing. And as Crash Davis tells Nuke LaLoosh in Bull Durham, you don't mess with a winning streak. And I made this mistake. I raised prices into the pandemic, particularly in the fall of 2020, I believe, but it might have even been a little later. We just did, to the point of our episode, we just did a bunch of cohort analysis at Pavilion, and it turns out that the earlier you are, the less you pay typically in Pavilion, because the first members were our biggest early adopters and I wanted to encourage them. And so those people paid not very much. And guess what? We looked at this one cohort analysis for people that have joined in 2018, actually 2017. Guess what our retention is for people that joined in 2017?
90%, 80%.
100%. We haven't lost a single person.
Wow.
And then it goes significantly down from there. But my point is that one of my regrets is raising prices as aggressively as I did. And instead of just enjoying like the 5, 7, 8 year lifetime value of some of these people, I flipped it. The economics are still not quite clear, that it still might be better, but we created a lot of thrash, as AJ would say, in our business because we had this amazing product market fit and we didn't treat it with enough care and consideration. And that's basically Jordan's point. He's a great guy. He's an entrepreneur in residence at Silversmith Capital Partners, looking for a nice $40-50 million company to buy where he can be CEO. And he's a great guy. Jordan Gutman, resident of Miami. Look him up.
I really liked that post. I thought it was really sharply laid out. We noticed this actually in our market. So in 2021, most of my competitors increased their fees, which is kind of interesting because in our industry, we charge not for projects, but for one-off searches, we charge as a % of compensation. So if compensation is inflating, we are already benefiting from it, right? But then they increase their percentages in quite an aggressive way, and we knowingly didn't. And last year, I spoke to a number of our top investment partners, and they said, the fact that you guys didn't and they did, right now there's a scarcity of demand coming out of our portfolios, and we're pointing it all to you guys because we felt that you didn't price gouge us when we needed support. You gave it to us and you were fair to us, and we're going to be good to you guys in this market. And I thought that was really an interesting thing to feel out. It was a great post. I'll go next. AJ, you can close it up. I am currently, we're in the soft launch phase of our newsletter. And so we've sent out 2 versions of it. The third one is supposed to go out this week. And then after the 4th, it's going to be publicly available. Just trying to get the muscle going and get the flow right. I've been looking at different resources to help me write or get good at writing. And I came across a podcast by this guy called David Perel, and it's called How I Write. And he interviews just some of the best writers out there, but business writers. So everyone from like a Tim Ferriss to, I don't know, the guy who runs Basecamp. And it's just so interesting to understand people's processes of how they get that type of content out of their heads and how different all these processes are. It's been fascinating for me. So if anyone's trying to develop that muscle, you might like that.
So my shout out is going to go to all the CROs that were at the CRO Summit. Sam asked during one of the sessions, actually I think it was during the keynote with Mark Roberge, how many of you watched Topline, and 50 to 75% of hands went up.
What's up?
Sam, which is
it was
awesome.
a lot. It was awesome.
Yeah. Listen to Topline. But I have a piece of paper and I've got some quotes down.
And didn't that woman walked up to you and had you sign her chest, right? With that.
Not Jensen, unfortunately. didn't happen that way.
That was so good.
But here, I did have people come up to me and here's some of the quotes. First quote, "Where's Osid?"
Oh,
that's a good one.
I like that.
Second quote, "Is Osid here?"
Ooh.
Oh, that's a really good one.
Third quote, "When is Osid coming?" All the quotes. And then the more important quote was, "AJ, don't tell the other 2, but you're my favorite co-host."
These quotes are so illuminating.
My favorite quote of the conference, which it was so great because Sam clearly made it up on the spot, but it was such a good quote. Sam, don't hate me for this, but it's like giving a teenager a bottle of Jim Beam and a Mustang. That was like a hilarious quote.
That was a good one.
And
what was it in reference to? Was it like too much capital, maybe?
Yeah,
too much capital. But you clearly you said like, I think you said Mustang actually first, a Mustang, and then it was like ... and a bottle of Jim Beam. So it was really
not
good.
a good idea.
The sessions were fantastic. I think the thing I liked the most was that there was time and space for the CROs to get to know each other. And there was a lot of table talk, great happy hour. So really great day. And kudos to the Pavilion team, to Kathleen, to Josh, to Aaron, Colin, to Sam, I guess. I don't know. Shout out to Sam.
They did it. I didn't do it. I think they did a great job. It was, I will say that a structured networking, like making it easy for people that are introverted or shy to have easy interactions where they can get to know other participants in a way that extracts value from those interactions is key.
Changed my career.
Ah, nice.
There we go. Well, this has been episode 62 of Topline, ladies and germs. Give us 5 stars on the iTunes store or Spotify, wherever you get your podcasts. Read us open. First, we need you to open the newsletter. Then we need you to read it.
Are you tracking the data on that?
Yes,
Austin?
and it's because it's racism. They don't like his name, so they're not opening.
Racist people open my emails.
I'm just kidding. No, but it's the Topline newsletter. What does it come out on Thursdays? Right?
Thursdays.
Any particular time?
No idea.
All right.
No idea.
He's not going to miss a week. He promised he's not going to miss a week.
I'll be honest.
He's struggling right now. He's going to get better. He's going to become a great writer through this process, and we're going to see him grow.
And there we go.
God bless you. Thanks for listening, everybody. Bye-bye.
This episode was brought to you by AirCall, the business communications intelligence platform. Deliver a better experience for your customers and your teams at AirCall. That's AIRCALL.io. Save time, save money, and improve performance with a single communications platform.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.